Hi, thanks for watching this video. My name is Philip Evenden. Welcome to Whiteboard Wednesday. Today we're going to talk about life insurance. How exciting. But we're going to talk about the difference between term, the most commonly understood type of life insurance that you can own, and permanent insurance, which is less well understood because there's more variations on a theme. So the way I explain it to my clients is this. If you take a graph, so this is time and this is money or value. Let's say a person's 40 years old and we'll say this is age 100 and this is age 80, let's say. So they're buying life insurance of X amount. It doesn't really matter. If we talk about term insurance, let's use a different color here. If we talk about term insurance, blue will represent term insurance, okay? So the first thing I want to point out is insurance companies know roughly how long we're all going to live, which is kind of creepy, but in actual fact, they just have statistics that show how long people live. And in fact, what's changed recently is all the insurance companies had to change their actuarial tables because people are living longer. So if you look at the cost for an insurance company to insure you at age 40, let's say it's represented by this blue dot right here. And what it would cost them to insure you for X amount of insurance at age 80 would be somewhere here, okay? Simply because your life expectancy is actually about there, just over 80. So it would be a curve. It would be a curve that would look like that. And by the time you get to 100, the number of people out of 1,000 that die is probably 2 out of 1,000 because they're the only 2 left, right? Because everybody else has passed away. So that's kind of how the actuarial tables work. Now, if you're buying life insurance and the insurance company is selling it to you, they have to make a profit. So the cost for life insurance of X amount at age 40 would probably be about here because they'd need to build in a little bit of profit, right? Pay their expenses and all that sort of thing. But people don't really like having to pay a different amount for their life insurance every year. So what do insurance companies do? They package them in 10-year, 20-year, 30-year blocks. The most common is probably 10-year. So instead of paying that amount, which would be very close to your actual cost of insurance at age 40, for let's say a standard non-smoker, male or female, they price it a little bit higher so that they can leave the cost exactly the same for 10 years. Well, what happens at the end of 10 years? It jumps up simply because you're getting older, but it's sort of following this life expectancy line. And it stays there for 10 years. And then it goes up a lot and it stays there for 10 years, etc., etc. And so by the time you get to 80, I know I didn't put enough steps in there, but by the time you get to 80, it's extremely expensive. And what happens is you can't buy it anymore. So term insurance is very much like renting a property. When each of us started out, we usually rented an apartment of some sort. There's nothing wrong with that. There's actually advantages to renting an apartment because you can move to a different one with 60 days notice and there's nothing to do. You don't have to sell anything. At the same time, most people, certainly Canadians, like to own property, and so they tend to buy. And that analogy goes with permanent life insurance. So term life insurance is good for a term of time. People often buy it to protect themselves from having to pay off a mortgage or still having an outstanding mortgage balance if one of the spouses, usually both are working, passes away suddenly. They want to have the mortgage paid off. So let's say your mortgage is $500,000, whatever the number might be. And so you buy $500,000 of term life insurance because your plan is to pay that mortgage off in, say, 20 years. Well, you'll only have to pay, X dollars here. Let's say it's $100 a month here, and it'll jump up to maybe $400 or $300 a month here, but you'll be done in 20 years. That's okay if that's what you want. So that's term insurance. Term life insurance, you only pay for the cost of the insurance, if you will, and it's grouped in steps of 10 years or 20 years. So let's look at permanent life insurance. Oh, the other thing about term life insurance is when it ends or when you decide to cancel it, you don't have any equity. Exactly the same as if you rent an apartment and you leave that apartment to go somewhere else or maybe buy your first home. You don't expect to get any equity from the landlord. You know that that's it, we're done, thanks for the place to live, and you move on. It's the same thing here. Term life insurance has no residual value or equity. Permanent life insurance, cash value life insurance, there's different types. We'll get into that in another video in terms of the types of permanent insurance. Works a bit differently than term insurance. The difference is that the cost of insurance, if we're equating it to the actuarial cost here, the cost of permanent life insurance might be represented by a fair bit of difference. So you could say that you're being overcharged for the cost of insurance, which would be true in the early years. But the difference is this. Permanent life insurance guarantees that you only have to pay that same dollar figure all the way through, and it's guaranteed to last as long as you do. Even if you live to be over 100, you won't have to pay for it anymore. Yippee! But it will cover you for that death benefit or whatever the death benefit has grown to be at that time. The difference here is that with term insurance, if you get to be 70 or 80 and the premiums are getting really high, you might still want life insurance. You might have different reasons for owning it. In the early years, it might have been because you had a business loan or because you had a mortgage to cover off, and maybe the mortgage is gone now. But maybe you've accumulated a lot of assets. Maybe as a business owner, you've got a business that's worth a lot of money, or you have investments that are worth a lot. Maybe they're in a corporation. We should cover that in another video. But you've got a tax issue. Tax issues at death are very, very expensive because all of your assets are deemed to have been sold the day before death. And so the government says, well, whether it's corporate stuff or whether it's RSPs or RIFs or whatever it is, the government says, well, we've let you defer the tax on this all the way through your life. Now that you've died, we need to close the books and we need to get the tax paid. Now, if you're married, your assets, shares in a corporation, all of those things will go tax-free to your spouse. But once your spouse passes away, or if your spouse passes first, once you pass away, when the second person dies of a married couple, the tax has to be paid. And so we can kind of calculate what the tax bill might be, and that might be a good reason for owning permanent life insurance, because it might be a much more efficient way of taking care of the tax bill. But what's the difference? Well, if this is $100 a month, let's say, this might be $1,000. I don't know, it depends on the product, the permanent product. But when you consider that by the time you get down here with term insurance, you paid a lot of money into this policy. When you get up here, maybe this premium is $1,500 a month. You've been paying $1,000 all the way along, and not only that, but don't forget, what you may not know is that with term life insurance, the amount of insurance is level all the way along. Whereas with permanent life insurance, some is level that way, but some cash value life insurance actually goes up. So it might start at, let's say, $500,000, but it goes up by the time death actually occurs, it might be worth 1.5 million. Again, that's probably another video. But I wanted to explain to you the difference between permanent life insurance and term life insurance, because it's very important to understand that term life insurance, again, it's a good analogy. Term life insurance is like renting an apartment. It's good for a period of time, a term of time. Whereas permanent life insurance solves a permanent need. Whether it's something simple like last expenses and taking care of last expenses for funeral costs and that sort of thing, or whether it's more sophisticated, which are the things that we get into with business owners for estate planning and that sort of thing. So that's term insurance and permanent insurance explained. Hopefully it's helpful to you. Thanks for joining us on Whiteboard Wednesday.